Have you heard about a Kiddie Condo loan? Do you know what it is or why someone would do it? Today, I want to talk to you a little bit about these Kiddie Condo loans. My name's Miles Pitcher. I'm the owner of Superior Lending, loan officer here in Utah. This is a cool loan product that I think you need to know about. It is the right loan in some situations. Let's dive into it. But first, let's get an update on rates. Today's February 8th. This is an inverse chart. As the chart moves down, rates are moving up. And we shared with you last week that the Federal Reserve came out, they met. Since then, we've had a strong jobs report, which hurts rates. That puts more money moving into the stock market. We are still anticipating a rate hike by the Federal Reserve in March. We are also aware the Federal Reserve is going to stop purchasing mortgage-backed securities, and at some point in the future, rather than holding on to those mortgage-backed securities that they've bought, which is a pool of mortgages, they are now going to turn around and start selling those. The short of it is that is bad for rate. So this chart shows over here that we are in this range between these two resistance levels. So we have room to get a little bit worse on rates before we hit a resistance line. Check out rates in the big picture. They're still fabulous right now, but be aware we are locking our clients in and getting them locked in with anticipation that rates could get worse. I mentioned last week, I'll mention again, be ready to educate your clients. I've already started having clients calling up and asking, hey, I heard the Federal Reserve was going to raise rates. What are mortgage rates at now? Mortgage rates are not directly tied to the Fed funds rate. In fact, one of the reasons why they've got worse is because we know that the Federal Reserve is going to raise rates in March to combat inflation and try to slow down the inflation. So we've already priced that into our mortgages. So just be aware of that, help educate clients in that area. Kiddie condos. First of all, what is a Kiddie condo loan? A Kiddie condo loan is a loan that, first of all, it doesn't have to be a condo. So I'm not sure why it's called a Kiddie condo. And why is it a kitty? I'm not sure. We're not talking like the Meow cat. We're talking primarily about a child. But it is a loan that allows for a low down payment from a blood relative or by marriage or by law relative to come in and be the co-signer on the loan. It utilizes the credit and the income of the co-borrower to help the child or the student qualify. Do they have to be a student? No, they don't. Does it have to be a condo? No, it does not. It could be a townhome or a single family. A multi-unit property, 2 to 4 units, requires a much larger down payment. So usually we steer clear of those. But an accessory unit like a mother-in-law apartment is fine because this is an FHA loan product. FHA considers a mother-in-law apartment as part of a single family property. We'll go through some more details. Why would you do one of these? This is a great way for a child, a student to be able to get some home ownership so that the rents is being paid while they're at college or away from home is not just getting flushed down the drain in rent. It's going to help build equity, reduce the loan balance, and as homes are appreciating, it benefits them. Great way to go. It also allows for the child who does have to live in the property it allows for them to have roommates and to rent out those rooms to help compensate or cover the mortgage payment. Rents are skyrocketing and jumping up. So financially, this may be a better option or equal to what they're paying in rents right now. So it's a very worthwhile look to check it out. Some of the nitty gritty on it here is, as mentioned, the child has to own or occupy the property. Therefore, it is a primary residence. The child and the co-borrower, usually a parent, both of them will be obligated on the loan. Even though we're using the credit score income from the parent, they're both going to be obligated on the loan. As mentioned, they have to be related by blood, marriage, or law. If they're not, the down payment amount moves from 3.5% up to 25%. They will look at the credit scores of each borrower. So you have 3 bureaus for each borrower, and they will look and see who has the lowest middle score. and they will use that as the score in pricing out the loan. This brings up another thing. Many kids are credit invisible because their parents have taught them, hey, don't get a credit card, don't take out any loans, don't do any of that. I have a video in my library here about credit invisible, how to help someone get a credit score. So you may want to work on that first. The income of the parents must be sufficient to cover their debts and the child. So if the child does have a credit card but they have no job, the parents' income has to be able to cover all of those debts. We did talk about the number of units, the single family, condo, townhome, or a single family with a mother-in-law is ideal. 2 to 4 units, you're going to be moving into larger down payments. And this property has to be owner occupied by the child. It cannot be used purchased as a second home or an investment property. And I mentioned the advantage with roommates being in there. It really is a underutilized loan product that I think a lot of parents want to help out their kids, especially with prices moving up and rents moving up. It's a great way for a college student or someone who's just moved out of their parents' homes to be able to get their foot in the door in real estate and to have some home ownership. Again, let me know if you have questions, thoughts on this. My name's Miles Pitcher. Hope you guys have a great week. We'll talk to you later.